360 at these times.
Welcome back. You're still with us on Markets Today. Let's run you through the remaining headlines that we're tracking for you, which brings us to headline number 4. Divi's Laboratories was down close to around 8.5% to 9% after it disappointed in the second quarter. The firm's margins were at multi-quarter lows. Ekta joins us to run us through with a quick analysis on that. Ekta?
Well, definitely a top-down miss for Divi's Labs this quarter. The revenue was down around 7-odd%. The street was anticipating a growth of around 10 to 11-odd%. Margins were probably the biggest disappointment this quarter. It came in at a multi-quarter low of around 33.5%. The street was anticipating at least some amount of sequential stability, considering that the margins disappointed last quarter as well. So the street was anticipating margins of anywhere between 37 to 38-odd%. This resulted in a double-digit profit decline for the company this quarter. The company did hold an investor call during market hours, so they did state to analysts that one of the reasons probably that the margins were pressured was because of factors such as raw material volatility, as well as pressure in terms of the generic prices of APIs. But they seem to be more optimistic in terms of margin recovery once the custom synthesis business starts picking up. While this quarter's demand was impacted because of a change in product mix, because of a fast-track order when it came to COVID-19 not delivering in terms of numbers, though the street was anticipating that, as well as delays in some projects, they are optimistic when it comes to demand in the custom synthesis business picking up in the next couple of quarters. But that was not enough for the street to be more optimistic or see an intraday recovery. Possibly the street wants to see more in terms of the numbers being delivered in the next couple of quarters before they make that decision. Remember, cash on books also remain strong for Divi's Labs at over 3,300 odd crores.
Okay, all right. Ekta, thanks a lot for that. Well, Escorts Kubota fell close to 1.5%. It reported a weak set of numbers. A big drop in the margins. Well, that's what hurt sentiment. The management said it would take around 4 to around 5 quarters for it to get back towards normal levels. Sonia Shana is with us to run us through the key highlights. Sonia?
Well, thanks a lot for that. You know, we do know that the numbers were weak. The numbers came in on Friday itself. But just to quickly run you through the main reason for the disappointment, it's the big margin fall where the margins were down 540 basis points year on year. Now, brokerages have been very cautious on the stock ever since the numbers came through. CLSA maintains a sell. They have cut their target price to 1561 from 1612 earlier. They say that JP Morgan says that a continued market share loss is a bit worrying for the street. In the first half of the year, the market share has fallen about 40 basis points. The management, though, says that it will take at least 4 to 5 quarters for margins to get back to normal. It's because it's not easy to pass on the higher inflation to the consumers because the rural end of the market is still under pressure and there's a lot of competition. They said although it will take 4 to 5 quarters for the margins to get back to normal, they feel that this is the bottom as far as the margins are concerned. The market share has also gone up marginally in this quarter. Market share is up about 70 basis points and gone up to beyond 11%. However, they also ended the conversation by saying that the tractor industry will not touch double-digit growth this year. At best, it would be perhaps mid to high single-digit growth. So slightly cautious commentary from the management, and hence the stock continues to be under pressure. Back to you.
Thanks a lot for that, Sonia. Well, staying with earnings then, low-cost airline IndiGo has its eyes set on network and capacity expansion. Well, the IndiGo CEO, Mr. Peter Elbers, in an exclusive interview with CNBC, said that the company is targeting to ramp up capacity by 13 to around 17% by the end of this fiscal. The airline reported a mixed set of numbers in the second quarter. Let's hear him out.
If we see where we are today, we made a loss if we exclude it from foreign exchange. And if we were to exclude from the enormous increase in the fuel prices, we would have definitely in a much better spot. And if you see where we are today with travel numbers basically hitting 7% higher than the situation prior to COVID, with load factors in the quarter, which is seasonally weak, around the 80%, and with a yield, which is normally in this quarter going down by 10% as compared to the previous quarter, it's now running at just a 3% lower level. So if you take all these elements together, we see a very solid market development. But obviously, the price of fuel and these rate of exchange, as we just alluded on, had a negative effect. take a little look forward, we continue our capacity expansion and our network expansion in the fourth quarter going forward. Actually, in the second quarter, we have inaugurated our 100th destination. We continue to expand that network, and we expect to end this year in some 13 to 70% capacity levels higher than the pre-COVID situation. Clearly, demand, as we have seen, remains to be very strong, and that's also why we're taking a lot of measures in order to meet with this increasing demand. Clearly, our priority so far has been restoring the network.
And the fifth and final headline today, soda ash prices have been revised downwards for the first time in 18 months. Two major manufacturers of soda ash, that's Tata Chemicals and GHCL, both of them were in focus on the back of this price cut. Sonal Bhutra is with us to fill us in with more details. Sonal?
Thanks a lot for that. Well, GHCL and Tata Chemicals, they'll be in focus because soda ash prices, they have been cut for the first time since 18 months. And it is important for these two companies because they are two of the major producers in the country. Now, soda ash prices, they have been cut by 4% from 37,500 rupees per ton to 36,000 rupees per ton. Yes, it is not a big decline that we've seen, but it is start of a cycle where we are seeing softening of soda ash prices. Now, remember, these prices, they went up almost doubled in last 1 year from 20,500 rupees per ton in June 2021 to levels of 37,500 rupees per ton in June 2022 itself. Now, GHCL in its conference call and conversation to us had indicated that yes, soda ash prices could see some softening going ahead because of some supply coming into the market. From here on, apart from these prices, energy prices are also key to track because if energy prices, they come down, then soda ash prices will remain at current levels. But for now, first signs of softening of soda ash prices, and these two stocks will be in focus on the back of that.
Thanks, Sonal. Well, moving on then, TVS Motors ended the day more or less flattish. In a bull versus bear case, Nomura, UBS as well as Macquarie, they have a bet big on the stock. While CLSA as well as Bank of America, they've downgraded the stock. Sonia is back with us to run us through details about this bull versus bear scenario that's playing out on TVS Motors. Sonia?
Absolutely. There's a bull and bear case argument on TVS Motor, and I just wanted to put that forth for our viewers. On the bull case, you have Nomura, there's UBS and Macquarie. Nomura has in fact upgraded TVS to a buy. They've raised their target price to 1382. UBS has a buy with a target price of 1355, and Macquarie has an outperform. They've raised their target price to 1260. Now, the reasons are well known. The success of the new models, you've had a very good response to the new electric vehicle iQube. Margin tailwinds are the big positives. Nomura says that export challenges are likely in short term, but the TVS group will definitely outperform. Now, on the bear side, you have CLSA that has a sell with a target price of 932. They believe that the valuations are very expensive after the big run-up that we've seen in the stock. The stock is now trading at 30 times FY24 EPS. BofA Securities has downgraded to an underperform. They have a target price of 1030. Once again, they reiterate that valuations have no room for error at all. Also, the weakness in exports continues to be a bit of a concern. In the EV business, although the business is doing well, initially there will be losses which you'll have to sort of factor into the P&L. And there is competition risk as well. Competition is coming back aggressively in the electric vehicle space with Ola back at 20% market share. Honda is having a new EV launch next year, and macro headwinds in Africa will continue to drag the market. So there are equal cases for both a bull and a bear. You can take your pick.
Indeed, Surya, thanks for that. Well, moving to the IPO corner then, issues from Bikaji and Medanta. They closed today. Bikaji has seen a strong demand across the board. Medanta has seen strong institutional demand, but retail portion is still not fully subscribed. Yash Jain is with us to run us through all of those details. Yash.
Well, Nigel, for both IPOs, that is Bikaji as well as Global Health, which is Medanta Hospitals, they've received decent amount of investor interest for their IPOs. But I'll tell you what, it's Bujia all the way. For Bikaji, the total subscription received as on 4 p.m. is 26 times. The qualified institutional buyer or QIB category, that has been oversubscribed 78 times. HNI category at 7 times, retail category also at 5 times, and employee category not too far behind at about 4 times. The company is looking to raise about 881 crore rupees through this IPO. But guess what? The demand which it has received is for 66,000 crore rupees. For Global Health, that is Medanta, the total subscription as on 4 p.m. was 10 times. Qualified institutional buyer category at 28 times. Strong subscription in that that category. HNI at 4 times. Retail is still struggling with about 1 hour to go. But as on 4 p.m., it was subscribed 83%. The employee category at about 4 times. The company is looking to raise about 2,200 crore rupees, but it has also received demands for 22,000 crore rupees. The price band for Bikaji, of course, is 285 to 300 rupees a share. Global Health is 319 to 336 rupees a share. How much of the strong subscription numbers translate into listing premium? That is something that we'll watch out for.
Thanks a lot for that, Yash. Well, on that note, we'll have to wrap up on this edition of Markets Today. Thanks so much for watching.